Have you ever looked at a stock chart and thought, if only I bought that 6 months ago? Yeah, we've all been there. But here's the thing, spotting opportunity before it explodes isn't magic. It's understanding where money is flowing, and in Australia right now, the ASX is quietly becoming one of the most interesting markets on the planet. Over the last year, we've seen a massive shift in investor behavior. While US investors chase AI and crypto, Australian investors are sitting on opportunities in mining, healthcare, tech, and renewable energy, industries that are actually producing profits, not just hype. So today, we're going deep, and I mean deep, into the top ASX stocks to watch right now. We'll break down sectors, companies, and catalysts. We'll look at what's actually driving Australian stocks, and which ones might just be hiding the next 10x opportunity. And as always, I'm not here to sell you a dream. We'll talk numbers, performance, risk, and valuation, the real investor talk. But if you want to stay ahead of the curve and actually understand where smart money is moving, hit the like button, subscribe, and turn on notifications. It really helps the channel and helps me keep bringing you in-depth investing content like this every single week. Alright, let's get into it. You might be wondering, why should global investors even care about the Australian market? Well, the answer lies in diversification, resources, and growth potential. Let's start with some context. The Australian Securities Exchange, ASX, is one of the top 20 largest stock exchanges in the world, with a total market cap north of $2.5 trillion AUD. And while most people think ASX and instantly picture miners and banks, the reality is, the ASX has evolved into a far more diverse and innovative market than it used to be. Here's the thing, while US and European markets are crowded and sometimes overvalued, Australian stocks still have room to run. Many companies are trading at more reasonable multiples, backed by solid balance sheets, and, in my favorite part, they actually pay dividends. Now, let's break down what's driving this market right now. 1. Commodity tailwinds. Australia is a commodity powerhouse. Iron ore, lithium, copper, gold, and natural gas, you name it, they export it. But the interesting thing is how the global energy transition is reshaping demand. Think about it, the world's move toward electric vehicles, renewable energy, and green infrastructure means massive long-term demand for battery metals like lithium and nickel. Companies like Pilbara Minerals, PLS, and Allkem, AKE, have been quietly positioning themselves as leaders in this shift. Even with volatility in commodity prices, the underlying trend remains strong. The world needs what Australia produces. And here's where it gets exciting. While US investors are busy chasing Tesla or Nvidia, Australian investors have the chance to benefit from the companies supplying the raw materials that power those very industries. 2. The China connection. Now, you can't talk about the ASX without mentioning China, Australia's largest trading partner. For decades, Chinese demand has driven Australian exports, especially iron ore and coal. But as China slows down and shifts toward a more balanced economy, the nature of that relationship is changing. We're now seeing Australian firms diversifying their export bases, trading more with India, Southeast Asia, and even Europe. And here's what smart investors understand: when a market like Australia successfully diversifies its export dependencies, that lowers geopolitical risk and increases economic resilience. That's one of the reasons analysts have been more bullish on ASX equities heading into 2025 and beyond. 3. Rising interest rates and the banking play. Now, let's talk interest rates. Like most developed markets, Australia has faced rate hikes from the Reserve Bank of Australia, RBA. That's hit sectors like property and consumer spending, but it's been a boon for the big banks. Commonwealth Bank, CBA, Westpac, WBC, ANZ, and NAB have seen stronger net interest margins thanks to higher rates. And while they're not going to double overnight, these banks are the steady cash flow machines in most Australian portfolios. They also pay hefty dividends, backed by franking credits, meaning investors can receive tax-effective income. So while it's not flashy, the banking sector remains a backbone of the ASX, and a great place for stability if you're building a diversified portfolio. tech and innovation are quietly catching up. You might be thinking, sure, Australia's got rocks and banks, but what about tech? Here's the fun part, the ASX has been quietly building its own innovation ecosystem. Companies like WiseTech Global, WTC, Xero, XRO, and Pro Medicus, PME, have been some of the best performing stocks over the past few years. These aren't speculative startups, these are global businesses. WiseTech dominates logistics software. Xero runs small business accounting globally. Pro Medicus provides medical imaging software to hospitals around the world. These are high-margin, recurring revenue companies that happen to be Australian, and they're proving the ASX can be home to serious tech winners. 5. Healthcare and biotech boom. Then there's healthcare, a sector that's quietly been outperforming for years. CSL Limited, CSL, is basically Australia's version of Johnson & Johnson, a global biotech leader with plasma products, vaccines, and massive R&D spending. Smaller names like Telix Pharmaceuticals, TLX, and Clinuvel, CUV, are also gaining investor attention thanks to groundbreaking work in oncology and dermatology. This is where Australia shines: world-class research, government support for innovation, and access to global healthcare markets. 6. Renewable energy and ESG investing. And finally, green energy. Australia's abundant sunshine, wind, and natural gas resources make it a global hub for renewable investment. Companies like Origin Energy, ORG, and AGL Energy, AGL, are pivoting hard toward renewables. At the same time, smaller players like Genex Power, GNX, are working on hydro and solar projects that align with global ESG mandates. And investors, especially institutions, are taking notice. ESG funds have seen record inflows in Australia over the last 2 years, creating a steady demand base for companies leading the energy transition. So to sum up this first part, the ASX isn't just a sleepy market full of miners and banks anymore. It's evolving. It's diversified. And it's positioned right in the middle of global megatrends, from green energy to tech, from healthcare innovation to stable dividend income. In short, there's opportunity here, if you know where to look. We'll break it down into 6 key categories: resources and commodities, financials and banks, technology and software, healthcare and biotech, consumer and retail, energy and renewables. Each of these sectors represents a different type of opportunity on the ASX, from dividend reliability to long-term growth and global expansion. Let's start with the one Australia is best known for. Number 1. Resources and commodities. Let's be honest, when people think of Australian stocks, they think iron ore, lithium, and gold. And that's for good reason. Mining isn't just a sector here, it's the backbone of the Australian economy. But not all mining stocks are created equal. The goal is to find companies with scale, low costs, and exposure to future-facing commodities. A BHP Group, ASX, BHP. Let's start with the heavyweight, BHP. This is Australia's largest company by market cap and one of the most diversified miners in the world. They produce iron ore, copper, nickel, and metallurgical coal, the essential materials that power infrastructure and manufacturing globally. But what's interesting right now is BHP's shift toward future metals. They've been moving away from fossil fuels, selling off coal assets, and doubling down on copper and nickel, both essential for EV batteries and renewable infrastructure. Their 2025 outlook projects solid demand for these metals, driven by the global push toward electrification. Combine that with BHP's world-class cost structure and a dividend yield hovering around 4 to 5%, and you've got a blue chip that can pay you to wait. It's not going to 10x overnight, but if you want reliable exposure to global resource demand, this is your anchor stock. B. Fortescue Metals Group, ASX, FMG. Next up, Fortescue Metals. This one's for the investors who want a mix of resource exposure and growth innovation. Fortescue started as a pure iron ore play, competing with BHP and Rio Tinto. But what's really impressive is their aggressive expansion into green hydrogen through Fortescue Future Industries, FFI. They're betting big on becoming a global player in clean energy exports. Now, that move has raised eyebrows. Some investors think it's risky diversification. But if they pull it off, Fortescue could transition from being just a mining company to a renewable energy powerhouse. Think of it like what Tesla did for cars, Fortescue is trying to do for industrial energy. It's a high-risk, high-reward bet, but if you believe in Australia's role in the clean energy economy, FMG deserves a spot on your watch list. See Pilbara Minerals, ASX, PLS. Let's move to lithium, the white gold of the modern age. Pilbara Minerals is Australia's lithium superstar. They've gone from a junior explorer to a key supplier in the EV supply chain, with major customers in China and Korea. While lithium prices have cooled recently, long-term demand remains strong. Every EV, smartphone, and battery storage system needs lithium. Pilbara's advantage is their vertically integrated strategy. They are not just mining the raw material. They're also working on downstream processing, which means higher margins over time. And unlike many early-stage lithium plays, they're profitable. That's huge. If you're bullish on the EV revolution but want to play outside of Tesla or BYD, this is your ASX ticket. Rio Tinto, ASX, RIO. And of course, Rio Tinto. Rio is another global mining titan, focused on iron ore, aluminum, and copper. They've been quietly cleaning up their ESG profile after previous controversies, which is helping them attract more institutional investors again. Their balance sheet is rock solid, and their dividend yield is attractive for income investors. But more importantly, they're heavily investing in low-carbon aluminum production, a niche that's expected to explode in demand as the world pushes for sustainable manufacturing. Rio's like BHP's quieter cousin, stable, profitable, and globally diversified. If you want long-term exposure with less volatility, Rio fits the bill. Graham Stephan Verstyle note: if I was structuring a portfolio, I'd treat BHP or Rio as my base holding, and then sprinkle in smaller, higher growth names like Pilbara Minerals or Fortescue as satellite positions. That's your classic balance between stability and upside. Number 2. Financials and banks. Now let's talk about the real money machines of the ASX, the banks. Australian banks are some of the most profitable in the world. They benefit from stable regulation, high capital requirements, and one of the most concentrated banking systems globally. The Big Four dominate nearly everything. A. Commonwealth Bank of Australia, ASX, CBA. The big one. CBA isn't just a bank, it's almost an economic barometer for the country. It's Australia's largest bank, biggest home loan provider, and one of the most trusted brands. During periods of rate hikes, CBA's profits tend to expand because they earn more from the spread between what they pay depositors and what they charge borrowers. Right now, the dividend yield sits around 4 to 5%, and the payout ratio remains healthy. But here's what's even more interesting: CBA has been investing heavily in digital banking innovation. Their app is among the best in the world, and they're experimenting with AI-based budgeting and investment tools. So while many banks are struggling to modernize, CBA's tech-first approach might actually give it a long-term edge. B. National Australia Bank, ASX, NAB. NAB is the steady middle child of the Big Four. Not the most aggressive, not the most conservative, just steady performance. Their strength lies in business banking, serving small and medium enterprises, SMEs. With Australia's SME sector booming post-pandemic, NAB is well positioned to capture lending growth. They've also kept costs under control and maintained a strong capital base, which matters a lot in a higher rate environment. If you're looking for exposure to Australian credit markets and small business lending, NAB is your play. C. Macquarie Group, ASX, MQG. Now, this one's a bit different. Macquarie isn't your typical bank. They're a global investment powerhouse, often called the Goldman Sachs of Australia. Macquarie's expertise lies in infrastructure, renewable energy finance, and asset management. They've got exposure to toll roads, airports, solar farms, and data centers all over the world. That global diversification is a big deal. It makes them less dependent on the domestic economy and more tied to global growth. Macquarie's dividend yield is lower, but the capital appreciation potential is higher. If you want an ASX-listed company with true global reach, MQG is a must-watch. When I build portfolios, I like to mix one or two income stocks like CBA or NAB with one growth bank like Macquarie. That way, you've got consistent cash flow plus exposure to upside if global markets rally. This is one of my favorite parts of the Australian market right now. Because while most investors still see tech as a Silicon Valley thing, there are homegrown Aussie companies quietly dominating their niches on the global stage. Number 3. Technology and software. Now, before we dive in, let's set expectations. The ASX tech scene isn't like the Nasdaq. You won't find trillion-dollar megacaps like Apple or Microsoft here. Instead, you'll find nimble, highly profitable, and often globally diversified companies, many with recurring revenue models and surprisingly strong margins. And in typical Graham Stephan fashion, we're not chasing hype here. We're looking at cash flow, scalability, and durability. WiseTech Global, ASX, WTC. If there's one ASX tech stock that deserves your attention, it's WiseTech Global. They're the world leader in logistics software, specifically in the freight and supply chain management industry. Their flagship product, CargoWise, helps logistics companies manage complex operations, from customs documentation to shipping compliance, across multiple countries and regulations. In other words, they make the global shipping industry run smoother, and they get paid every single month for it. What's wild is that over 17,000 logistics providers in more than 160 countries use their software. Their margins are strong, growth is steady, and their revenue is recurring. Now, the stock isn't cheap. WiseTech trades at a premium valuation, north of 60x earnings at times. But that's the price you pay for predictable revenue and dominant market position. And here's a fun stat. WiseTech's stock has risen over 1,000% since its 2016 IPO. This isn't hype, it's execution. If you're a long-term investor who loves software as a service, SaaS, models, this is an ASX name to watch. Xero Limited, ASX, XRO. Now let's talk about another global Aussie success story, Xero. Xero provides cloud-based accounting software for small businesses. Think of it as Australia and New Zealand's answer to QuickBooks. But with a much friendlier interface and a huge international user base. They've built a loyal following among small business owners, accountants, and bookkeepers thanks to their ease of use and integrations with hundreds of third-party apps. What I love about Xero is their stickiness. Once a small business starts managing payroll, invoices, and taxes on Xero, they are not switching anytime soon. That's what gives them recurring revenue and high customer retention, exactly what you want in a tech stock. Now, the stock had a rough patch during 2022 to 2023 when tech valuations corrected, but Xero's fundamentals never really broke. They've since refocused on profitability, trimmed costs, and are delivering positive free cash flow. If you believe in the rise of global small businesses and remote entrepreneurship, Xero could be one of the most undervalued tech growth stories on the ASX. Seed Pro Medicus Limited, ASX, PME. Here's a fascinating one, Pro Medicus. It's not a household name, but it's quietly one of the best performing stocks in Australian history. Pro Medicus builds medical imaging software used by hospitals and radiology networks around the world. Their flagship product, Visage 7, allows doctors to view and share high-resolution medical images faster and more securely than traditional systems. Here's where it gets impressive. They're growing revenue over 30% year-over-year. They've got profit margins above 60%. And they've managed to expand into the US healthcare market, one of the toughest to crack. Their long-term contracts with US hospitals create recurring, stable income, while new deals keep driving growth. Now, the valuation is steep. The stock often trades at over 100x earnings, but this is the kind of company investors hold for a decade. It's small, niche, and incredibly well run. If you want exposure to both tech and healthcare innovation in one stock, Pro Medicus is an elite pick. D. Altium Limited, ASX, ALU. Next up, Altium. One of the most respected design software companies on the ASX. They develop software for printed circuit board, PCB, design, used by engineers and product designers worldwide. In short, every electronic device you use, from your smartphone to your car's dashboard, contains a PCB designed using software like Altium's. The company's business model is simple but powerful. High-margin recurring subscription revenue. Global user base, particularly strong in North America and Europe. Long-term industry tailwinds from IoT and electronics growth. What's even more exciting is that Altium is positioning itself as a key part of the electronics design cloud ecosystem, basically becoming the Figma for hardware. Their cloud-based platform, Altium 365, allows engineers to collaborate on designs in real time. That's a game-changer for the hardware design industry. In 2024, Altium was even rumored to be a potential acquisition target by US software giants due to its strong niche position and recurring revenue base. So if you want a company with a blend of software scalability and industrial importance, Altium is one to keep an eye on. Technology One, ASX, TNE. Finally, we can't talk ASX tech without mentioning Technology One. This is a homegrown SaaS powerhouse providing enterprise software to local governments, universities, and businesses. Their focus? Simplifying complex business systems like payroll, finance, and HR, all on the cloud. They've been profitable for over 15 consecutive years, which is rare in the SaaS space. And while most US software companies chase growth at any cost, Technology One quietly delivers both growth and dividends. Their revenue is sticky, their customers are stable, and they've built an incredible moat through long-term government contracts. It's not flashy, but it's one of the most reliable tech compounders on the ASX. If I were building a tech growth watchlist right now, it'd look like this. WiseTech Global, WTC. Logistics Dominance. Xero, XRO, Small Business Cloud Leader. Pro Medicus, PME, Healthcare Innovation. Altium, ALU, Design Software with Global Exposure.